The Fed has shifted up a gear to rate cuts, but do bumpier roads lie ahead? Welcome to Macro Matters. I'm Peter Devlin. As the Federal Reserve is now more confident that inflation is sustainably easing toward 2%, it is shifting its attention to the maximum employment part of its dual mandate. The economic shocks from the pandemic may be a distant memory, but the Bank of International Settlements has warned that disinflation may not be a safe bet amid fragile supply chains. So what side of the Fed's dual mandate will take priority in its easing cycle, labour markets or inflation? Well, to help answer that and more, I'm joined by Sam Tombs, Chief US Economist at Pantheon Macroeconomics. Sam, thank you very much for joining us. So starting with the employment and non-farm payrolls far surpassed estimates at 254,000 jobs. Was the Fed too heavy-handed, starting with 50 basis points? And what's next?
No, I think the Fed was right to start with the 50 last month. And I don't think this latest batch of labour market data should really cast any doubt over that decision. In fact, I think they'll still likely be easing at the next two meetings this year. Of course, we have another payrolls report still to go as well before the next meeting in November. And I think there are signs that this print could well be revised down. The response rate for this first estimate was extremely low. Just 62% of businesses in the sample actually replied, far below the normal 70 to 80% range. And we have seen most months a consistent pattern for the first estimate to be revised down considerably. So we think this is a candidate to see another substantial downward revision, in which case that slowing trend will probably still be apparent in a couple of months' time.
So with that next NFP print in mind, massive furloughs at Boeing and the effects of Hurricane Helene will start to feed through by then. Could we see a negative print in October?
I think a negative is a bit of a stretch. I wouldn't rule it out, but the furloughs and strikes at Boeing look set to subtract about 45k from private payrolls growth in October if those actions continue into the survey week, which is next week. And there may well be some wider disruption as well, of course, because suppliers for Boeing may well be slowing down work for a few weeks while that action is going on. And then, of course, we have the hurricanes as well, which could well be adding to some disruption as well in the payroll survey week. So, yes, I think October's print will be much weaker, below trend, and we could be looking at something like 50 to 100k for private payrolls growth for October, given those disruptions and more fundamentally the subdued level of hiring indicators that we're seeing, across the board now.
Sam, you mentioned as well those large revisions month to month with the NFP prints. So are the Fed and markets putting too much weight on a potentially unreliable measure?
Yes, we're seeing ever larger revisions, particularly downwards at the moment, to the first estimate of payrolls growth. And I think the Fed understands this. It monitors the quality of the data very carefully. It consults a wide range of indicators and doesn't place too much weight on any one data point. So I don't think that this is going to fundamentally change the direction of policy. They've signaled that they will likely be easing still at the next two meetings this year. Of course, I don't think they're likely to go with another 50 basis point easing at November's meeting, given this data, and perhaps some firming in the inflation numbers that we're seeing at the moment in the August-September period. But nonetheless, with policy still where it is very restrictive, and I don't see a fundamental reason to keep it so tight for so long anymore.
So a broader look at the economic data as well. This week we saw US services sector activity, which does account for more than 2/3 of the economy, accelerating in September. Can a series of rate cuts ahead be justified with the economy remaining on solid footing?
Well, it looks as if the third quarter as a whole was another solid one for the US economy, with growth around 2.5% annualized, is what we're tracking at the moment, given the available data. However, I would emphasize that it's normally the payroll numbers that do give you a better steer on the position of the economy than GDP itself. And whilst we have had one hot number for September, the trend over the last 6 months has clearly been weakening. And as I've mentioned, I think that it's highly likely that that September number will be revised down as well in time. When we look back through past economic cycles, it's actually been the payroll data that have given a much better real-time guide to what's happening in the economy than the GDP numbers. So the slowing over the last 6 months, that clear slowing trend, I think, is more indicative of the current position of the economy, and certainly warrants the FOMC continuing to ease at its upcoming meetings.
Well, we look to the US port workers' strikes as well. Reopened overnight, but investors will be keen to gauge any economic fallout. Comments from Chicago Fed President Austin Goolsbee, arguably the Fed's biggest dove, had to admit that those port strikes could pressure prices. So overall, do you think that the Fed is willing to turn a blind eye to one side of its mandate to deliver further cuts?
I'd be surprised if we see material impacts on the CPI numbers from these port strikes, given that they lasted less than a week. Businesses had time to prepare for this many weeks in advance, and there's enough slack in the supply chain, I think, at the moment, both in terms of import and export volumes for the queues that are built up over the last few days to be remedied quite quickly. So I'd be surprised if there was really a CPI impact from the disruption we've seen. It's been short enough for it to have no real impact on prices. More generally in the CPI numbers, I mean, we've seen a clear slowing in the rate of price increases. Perhaps some of that may reflect some seasonal adjustment issues with the data. The slow may have been a bit exaggerated in the last few months, so I think we might see some of that unwind over the next couple of months. But really, when you look fundamentally at the inflation outlook, we see energy prices having fallen quite significantly over the last 3 months, supply chains normalizing, apart from that brief port strike, and wage pressures easing markedly as well. Many leading indicators of wages are pointing clearly downwards, easing that pressure on services firms' costs. So we don't really see much price pressure in the pipeline ahead, and I think the Fed will be able to fully focus on the labour market, which likely still will be weakening through the winter months.
So finally, Sam, just looking ahead to next week, Fed minutes are due up. Last month, Fed's Michelle Bowman spoke out against cutting by 50 basis points. That was the first dissent since 2005. Are the days of the FOMC speaking with one voice in the past?
Well, I think we may be heading into that direction, and there's been an unusual period of unanimity in terms of the votes and messaging on the FOMC for the last 18 months or so now, and there is a range of views on the committee as to how quickly they should be easing. When you look at the latest summary of economic projections, there is a range of views as to where the neutral rate is and how quickly they should get there. So I wouldn't be surprised if we continue to see votes away from the consensus at upcoming meetings. But the core members of the committee still seem to be very much focused on that labour market picture, which is fundamentally weakening despite this blip we've seen in the September data.
Sam Tombs of Pantheon Macroeconomics, many thanks for your thoughts. And that's Macro Matters. Don't forget you can watch more videos on Reuters.com.